Hello, hello. How are you?
I'm doing well. How are you?
I'm doing
You guys
good.
ready?
I'm still drinking my little cafecito.
Okay, awesome. Good morning, good afternoon to all of our Facebook followers out there. For those of you I haven't had a chance to meet before, my name is Patricia Mota, and I am currently serving
Hello, how are you?
President and CEO for the Hispanic Alliance for Career Enhancement. And I've been in this role going on 5 years, and given the current shift in the times that we're currently in, we've decided to launch a series of various virtual resources that HACE can provide to you, including virtual new job board, including weekly webinars on various topics, free career coaching on a weekly basis, and also Cafecitos con HACE, which are weekly conversations on various topics brought to you by various subject matter experts that we have at HACE. And before we get started on today's topics regarding your finances during COVID-19 and understanding what are the top things you should know, not only for your retirement, but also for those of us that have student loans as well. And we have two amazing financial executives joining us that are amazing in their fields of work, and also for HACE, amazing board leaders as well. And so before we get into their questions, I have to ask you that you can please ask any questions on the Facebook. We will get to them. And also, we have an alumna with Cafe Ama. So Angelique Sina, who's a Mujer de HACE alumna from DC, has been gracious enough to donate for the first 10 of you that like or comment, to please send us your email address via Facebook, and you will get a free coffee bag. Olga, I know you have it there. Can you hold it up? Of Cafe Ama. So this cafecito from Puerto Rico is developing entrepreneurship for both women and children in Puerto Rico. And so we're gracious to have their support for our weekly cafecitos. And again, the first 10 of you to like, comment, ask questions, we will send you a free bag, or Angelique Sina and Cafe Ama will send you a free bag of cafecito. So
I just liked it, Patricia. Do I get a bag?
I don't know if
you don't count. You don't count. This is for viewers.
You also are now chair for HACE. What should we know about our retirement?
Sure. Well, one of the first, a lot of the questions that I've been getting really has to do a lot with, I'm going through an economic struggle, and does it make sense for me to withdraw from my 401k? And the truth of the matter is, that's something that a lot of experts across the nation will basically try to have you stave off of, not trying to, take a distribution from your nest egg. But the truth of the matter is that right now we are going through unprecedented times, and a lot of people are struggling economically. And so the government, in understanding of that, has made taking a distribution, a withdrawal from your 401k easier. This is through the CARES Act that is out there, and typically this will apply only to, and you will be able to do this only if your employer has actually adopted the provisions of the CARES Act. And so before you can even decide that you want to do that, you need to make sure that you check in with your employer that this is available to you. So what does that mean? So, and who qualifies? So people that have been affected or diagnosed by the COVID-19 have that, or a family member, a spouse, a child, they qualify for this. Anyone that has been subject to quarantine and can't get to work, obviously will be sometimes affected by not being able to make, ends meet and not collecting income during that time. A business closure for individuals that have businesses and have access to a 401k, this also applies to them. And also for individuals that don't have the ability to bring in childcare. A lot of schools right now have been close to the end of the for the end of the school year, and unfortunately, these are individuals that don't have another way of taking care of their child if they're not there themselves. And then again, also for those individuals that are that were laid off and have reduced hours or on furlough, these are all individuals that qualify for this opportunity. So what is the opportunity? You would be able to get a distribution from your 401k at this point, penalty free. And that is actually something that in the past, when you do take a distribution, you have to pay a penalty if you're not at least 59.5. And then you would also need to pay the income tax that corresponds to that. So the penalty has been basically eliminated until, I believe it's until September, end of September, more or less. And again, just so you know, a lot of this keeps changing. That could be extended. So we need to know that this is a fluid situation. And then the only other thing I would say, this is high-level, we'll get into questions later on. Before you do any of that, please consult with your financial advisor and your accountant for, just so you can make sure that you are planning this the right way. And the only other thing I guess I wanted to say is, yes, for the IRA, individuals that are supposed to take a required minimum distribution this year. So if you are required, you actually don't have to take it this year. That's again, something that you can hold off on. A lot of individuals don't want to go into sometimes and take out distributions from their 401k or their IRA because what we see right now with markets is they're very volatile. So sometimes they'll say, well, I don't want to take a distribution right now because of the volatility in the marketplace. But so for now, you don't have to do that. And I think for now that I'll just wrap it up a little bit right now.
So a couple of follow-up questions. So one is to reach out to the employer. The employer would be the first point of contact. And then, the second was to advise with the financial advisor. So if someone doesn't have a financial advisor, what recommendations would you have for that?
Yeah, certainly, Juan and I are, obviously we are part of the financial industry. We work within this realm. So if anyone doesn't have a financial advisor, at least send us give us a call. We'll be able to help you out and, and find you the right individual or answer.
Awesome. Thank you.
I would also say that, your benefits company should have typically a toll-free number where you can call and ask questions of as well. One thing to keep in mind, I think this is all great really timely and important information, but your retirement plans, your 401ks or 403bs or IRAs should be an access point for funds of kind of last resort, right? And so if there's an emergency such as this COVID-19 coronavirus situation, then clearly it's a place where you would want to access funds. But quite often, if your employer is offering some sort of match, right, to your contributions, and if we take a loan or take a withdrawal from our retirement accounts, quite often participants at that point, they're either paying back the loan and maybe they stop contributions. And when you stop your contributions, you're no longer receiving your match, right? So you want to be cognizant of how this action of potentially taking money out of your retirement plan may impact you in terms of taxes, as Olga mentioned, the penalties, which can be waived if it's coronavirus related. But then also if you're then not making contributions because you're paying back your loan, if you're missing out on your match, that's going to have an impact on your future balance and your future growth.
And then the only thing I'll close out with is, so in the past, participants have only been able to take out distributions up to whatever it is they're vested to, which is I think like 50% of whatever their balance is. Right now, they can take it out 100%. And again, that's obviously because of the current situation that we're in. And this is something that, again, is just being made available to individuals that really need this.
Yeah, and this is good to know, right? Because if you are in a situation that this could help you out financially, then it's a good option to have. But again, keeping in mind that,
it's the option of last resort.
Exactly. Well, thanks for sharing that, and I'm sure we'll address a few of the questions that come regarding this. The second piece of the conversation that we wanted to touch on too, which also there was a lot of information within the last 2 weeks that came out regarding student loans. So we have various folks in our network that are paying off loans, student loans, and so what should we know? And I'll ask this to Juan. What should we know about this?
Yeah, so as part of the CARES Act, there was also part of the legislation was student loan relief, but this is specific to loans held by the federal government. So there was a 6-month automatic payment suspension, what they call administrative forbearance for any student loans held by the federal government. I think this period, just like as Olga had mentioned, ends on September 30th, 2020, but it could be extended as well. So this would be things like federal Perkins loans, the direct loans, like the PLUS loans, federal family education loans, the FFEL. So private student loans are not eligible for this, although so if you do have private loans, then you'd want to check with those institutions that are running those loans in regards to that. So during that period, the loans are just accruing at a 0% interest rate. If you have set up automatic debits for the federal loans, then they just put those on halt. You can still make payments if you want to make payments, but the entire amount of the payment is going to reduce principal, right? So there's no interest. So that's a way, maybe like if you're able to continue to pay, as you continue to pay, and you can reduce your principal amount. And so, as of right now, it runs through September 30th, but it may or may not be extended.
Okay. Anything you want to?
And I know we have a piece, Patricia, that we sent out, and that's something that HACE also sent out. It was like a 2-pager, and you can feel free to forward that to anyone who has questions as well.
Okay. Do you want to share that on the screen? I don't know if you want.
Yeah, I could do that. I could let me grab the screen if it allows me to.
Anything you want to add to that, Olga, while he pulls?
Can you guys see my screen?
Yes.
Okay, cool. So this is a one pager or a 2-pager that we have that just kind of goes through this information. There's also a number that you can call or an email address here at the bottom for federal aid assistance if you have questions regarding this. But we'll go ahead and send that out to everybody.
Okay.
Yeah, I think that one of the biggest things that a lot of individuals, whether you are a student, if you are someone that's been furloughed, anyone that's been laid off, the biggest thing right now, and Juan and I talk about this all the time, even for business owners, it's about how do you really reduce all of your expenses as best possible right now. And again, a lot of the forbearance is also being utilized, that opportunity with mortgages, right? Individuals that have that mortgage, some banks are giving, a few months of the opportunity to defer that payment. It could be 3 months, it could be 6 months. It all depends on the bank and what they're willing to do. What happens there is at least you have that opportunity to not worry so much about that short-term, liability that's due, but it will get added obviously at the end, and whatever, and they'll have other options for you as well at these banks. So right now, just think about what you really do need while you are in this situation, and cut off expenses that I'm sure, I know I went through my own expenses and I cut out a couple of expenses, and it's just one less thing you have to worry about. So take advantage of that. And a lot of people, I feel that they can probably write this out and won't take action in terms of, like, again, calling up your bank, calling up even your credit cards at this point. They will go ahead and defer a couple of payment, like defer your payment a month, 2 months, 3 months. Call them up. They're all doing something different. I know that because I was speaking to a couple of people over the weekend, and they really did take control over this, somebody that was furloughed. And I really commended her for being so proactive, and just not that she was pressed to do it right now because she has savings, but what she's doing is she's cushioning herself, right? And that's what you do right now. Don't wait to the last minute. If you believe that you can benefit from, being able to defer these payments, you should do that. Think about that.
The other one I heard of, your auto insurance companies that are offering, to cut down on your monthly insurance. So that's another one to make a phone call. Before we jump into the two questions, just a reminder to everyone out there to, if you are to like, comment, to please share. Again, these are our weekly Cafecitos con HACE series. And also, the first 10 of you who have commented, please send us your email so that you can have your bag of Café Ama. Thank you. So guys, we have a question here. Mm-hmm.
Well, Patricia, I was going to maybe add a little bit to, a lot of questions that Olga and I are getting are coming from participants in retirement plans concerned about the market, right? And the volatility and the pullback that we've had, because I think for many of us, right? And, if you think about a lot of Gen Xers, this is probably the first real big pullback that they've felt on their investment assets, because maybe in 08, 09, they either, weren't investing at that point or they weren't in the workforce. And that was the last major correction that we had. So I think, the key is to just make sure, clearly, we're not giving financial advice here, but just in general terms is that you want to make sure that, in most of these plans, you're making a contribution, potentially your company's making a contribution, but it's up to you to decide how to invest your money. If your plan has some sort of target date fund, then potentially you're invested in a target date that with a date close to when you might be retiring, and most plans will use age 65. So it's going to be diversified in stocks and bonds and cash, but based on that longer term or that date, that horizon. And for some people it might be shorter term, and for some people it might be longer term. It doesn't mean that there's not going to be volatility, right? You're going to see those ups and downs there. So, we've seen from top to bottom on the S&P 500, which is the major market index for the stock market here in the U.S., a correction of in mid-March of about 34% top to bottom. Right now, we're off about 11 to 13% year to date and top to bottom on the S&P. So we've seen a little bit of a recovery. But as we all know, we're sort of in the midst of this new normal. We don't know how long this is going to last, what the impact is going to be to businesses, to individuals. It sort of was like somebody pulled that handbrake on the economy, and it's not just going to be a light switch where all of a sudden we're back up and running. It's going to take some time, right? So how is this all going to recover? So the key is really to go back and look at your investments and make sure that you're properly allocated based on your age and based on your risk appetite. And either your advisor can help you with that, or typically your plan should have some tools available where you can kind of go through that process. And if you're in a target date fund, then if it's allocated to when you turn 65, you're going to be invested appropriately based on that year. So what I would tell you is when the markets are down, 20 or 30 or 40 or 50%, you see it, you feel it, and it's very scary. But if you're invested and you have 3, 5, 10, 20, 40 years, if you think about it, somebody who's 25, they've got 40 years until they turn 65. So they have some time to allow the markets to come back and recover. One thing, if I can just kind of share here on our screen, this is a piece that we've been sharing with and having conversations. You'll see the financial crisis back in 08, 09. You had a correction, and that was different, right? That was a major foundational challenges within our economic and banking systems, right? And it lasted well over a year and a half, and we saw a correction of 57% top to bottom on the S&P 500. Subsequently, over the next 12 months, it recovered 68%. And then it took about 3 years to get back to where the high that the market had been. And then we had a subsequent 7-year bull market after that. So the key is like, if you're near retirement, or you know that these funds aren't for retirement, that you'll need these funds sooner, then you want to make sure that you're allocated more conservatively. But if you have 5, 10, 20, 30, even 40 years, if you're in your 20s and you're allocated more towards growth, longer term, you're going to be okay, right? In 08, 09, people who lost money in the market weren't really people who, in their plans, weren't really people who had money in the stock market. It was people who had money in the market. They got scared. They sold everything and moved into their cash option or their money market option, because what they did was they locked in that loss, right? They locked in that down 20 or 30 or 40 or 50% whenever they made that decision to get out, and then they didn't participate in the recovery, right? So just remember that if you're still participating in your plan and the market goes down, your investment goes down, if you're making contributions every pay period, you're buying on sale. If your company is making a match, then their match, you're also buying on sale. And if you're in your 20s or 30s and you've got 40 or 30 years, you've got plenty of time for that money to recover, right? So, people who got out of the market. Go ahead, Patricia, I'm sorry.
Yeah, I think this kind of touches on this question that we have from your tocayo, Juan Trigueros. He says, I'm a recent grad and my employer is terminating the rotational program. So he's in a rotational program of July 2021 due to company strategy shift. If it takes 3 years to be invested at the company, what occurs with the money that I would have accumulated up to July 2021? And is there certain actions I should take prior to July 2021?
So specific to that, he's got to take a close look as to that vesting schedule. So typically in these plans, you're fully vested in whatever you've contributed, because that's your money, right? So if I put $5,000 into the plan and that $5,000 is now worth $6,000 or $4,000, that's my money. I take that with me. If they have anything that I rolled over into the plan from a previous plan, that's my money also. I take that with me, and wherever it's grown or declined to, right? If they have a safe harbor contributions, those are fully vested as well. But if there's a vesting schedule on a portion of the contribution that you're getting from the company, so that 3 years, and he may have provided specifics, but that could be where it gradually vests over 3 years, or where he's not vested until he completes 3 years. So there's not really much you can do. You're going to leave behind whatever you're not vested in. So if Juan is not, if he's 40% vested in on that portion of the contribution of the savings that the company's provided, then he'll take 40% of that and leave behind 60%. He can't really do anything to protect that, because that's part of that deal, but he'll take everything that he put into it, anything he rolled into it, and if there's any safe harbor contributions the company has made, those are fully vested. But you've got to abide by that vesting schedule, and that gets left behind in the plan.
I'll just add that a lot of employers are deciding how to do that individually.
Mm-hmm.
There are employers right now that even though they have furloughed individuals, that they are paying for certain benefits still. So Juan, it would be a good idea for you to go back and check with your employer to see how they plan to handle that. So that's just, just got to make sure that you have that conversation.
Yeah, let's get another 2 questions. And this one's from Debbie Vass. And she's like, what are your thoughts, interesting question, on borrowing from your 401k now that penalties are waived in order to purchase a property in the current marketplace? Are interest rates at a good place right now? I don't know. I mean, go ahead.
I'll go first, Olga, and then you can jump in.
I'm going through a refi. I can tell you about that.
Yeah. What I would say is that just, you want to find out first what the terms are for the loan with your retirement plan, because each plan provider will work with the plan sponsor and set an interest rate. So it could be prime plus 2, or it could just be prime. So some plans may have more expensive interest rates related to them. So if we're in a low interest environment, which we are in, so that's positive, are we in an environment where real estate is corrected very much? And the answer to that is not yet. I mean, maybe a little bit, but not necessarily a significant amount, right? And then, you're able to borrow typically 50% of the value of your vested amount in the plan if they offer a loan. So not all retirement plans, 401ks and 403bs are required to offer a loan. It's something that the plan sponsor, which would be the company, decides, do we want to offer loans or not? So if they offer loans, and then typically you can borrow up to 50%. Aside from what Olga had mentioned, if it's coronavirus related, then and they've adopted, this new regulations, and it's 100%, right? So, but you want to take a look and see what's the payback period. Is it 5 years, or maybe for primary home, it might be a 15-year payback. What's the interest rate? Is it just the 50% of my vested balance? And so how much can I borrow back and do? And then, and back to my previous comment is just, even at that point, just make sure that if you're borrowing, right, I've got to pay that back. So a lot of times while I'm paying that back, I'll say, I'll pay it back, but my cash flow is impacted where I can't pay it back and make the contribution. So if that happens and they have a match, and then I'm foregoing that match and I'm not getting that match, and I probably want to make sure that I'm taking advantage of that match. So I would say, Debbie, just take a look at all those factors. And if you have any other questions, let us know. Olga, I know you definitely are going through that process you mentioned on the refi.
Yes. So one of the biggest things that, this is an opportunity, obviously, to refi some, if you're able to. And also, obviously, if you want to buy a home, that's obviously, this might be a good opportunity. It all depends on the individual. But I do know also that for individuals who are trying to refi or are trying to purchase a home, obviously, right now, a lot of these mortgage lenders are going to be looking to see whether or not you're employed, and they're going to be looking at your cash flow. They're also going to be looking to, there are more requirements right now. Interest rates may be low, but there are way more requirements now in terms of like, okay, you have to put down a 20% down payment on a new home. And, you have to look at the current environment, if it makes sense for you, if it's a primary home, primary residence, that your first home, then, it's all, again, on an individual basis, what you want to do, but that you wouldn't have to pay a penalty on that. You just basically go through the process of getting your borrowing against, your 401k and then paying yourself back, but there is no penalty, because I believe that was part of your question.
Mm-hmm. Yeah. And then, but the last question, guys, and those of you out there, be sure to like, comment, share, because this will continue to be a resource on our Facebook page for those who can leverage this information. Then the next question is, how will reducing the principal on my student loans help with future interest?
Typically, when you're paying down, and this, would work for the real estate as well, right? When you're paying down principal, then it just reduces the amount of the number of payments that you have to make down the road. So you finish your loan sooner than later. So it's a strategy that people will employ both with their mortgages and student loans, where they might say, I'll make an extra, 50 or 100 or 300 or whatever amount payment each payment period, and I'll allocate that towards principal, and then it reduces the length of your loan. So it's a nice strategy. I know that, like some people on with mortgages, if you've got a 30-year and you pay 2 times your mortgage or your monthly amount, then it reduces a 30-year to like a 17-year, because you're paying it down sooner. So you're just allocating it. So it just helps you. It reduces the amount of interest that you pay over time and the length of the loan as well. Olga, I don't know if you have any additional comments to that. Or...
No, that's exactly that's the strategy that you should be using if you can. Paying down less interest. When you take a loan, your goal, I guess the ideal goal is to pay 0 for that money. So the faster that you are able to pay for it, the better, reducing overall interest expense.
Guys, I'm out of Cafecito. I don't know about you. We're out of time. I know we have other questions, and thank you guys for making yourselves available for this conversation today. We'll also be checking in. If we did not get to your question, we'll make sure that we'll respond on the Facebook page and share any additional resources and information that you may need. Thank you, Olga. Thank you, Juan.
Yeah.
Pleasure.
I would say make sure everyone likes it, because we need to get that coffee out of Olga's hands. Otherwise she keeps it all. So just please.
Bueno, saludos a todos. Enjoy the rest of your day. Thank you, guys.
Adios.
Cheers, everyone.
Bye.
Ciao.